Welcome to DROX Investment Group Show, your source for apartment investment, operational strategy, and market analysis. Your host is Huynh Do, CEO and co-founder at DROX Investment Group, a Houston, Texas-based multifamily operator who has purchased and invested over thousands of apartment units and managed over $280 million in assets. Join us as Huynh Do interviews experts from all over the country as they share their wisdom and inspire you to grow, invest, and to impact. Here is Huynh Do.
For your very precious time to come in today. Okay. Multifamily syndication. So it is a real estate syndication of an opportunity for all the investors to come together to purchase multi-million-dollar apartment. So for example, myself, Huynh Do, I can probably go buy, $100,000, $200,000, $300,000 home, or maybe a $500,000 home. But when you're talking about a $60 million apartment complex, there is no way Donnie and myself can do it. And this is why it's a team effort. And we can show you later on, this is where you say, who are you going to partnership with? And what does that mean by when you partnership with the general partners or limited partner? What does it all mean? So for each investor, in order for you to become an owner, you in exchange your capital, putting in your fund in exchange for a percentage of the ownership. So similar to like a stocks shareholder in a corporation itself. And as a passive investor, you do not need to do anything, right? You basically relying on the general partners to do all the daily works, and you're relying on the sponsors to do all those landlord works for you. Okay. So who are you partnering with? We are DROX Investment Group. We have invested over more than 1,700 units in the Houston and Dallas area, total of $280 million. We are licensed real estate agents, and Donnie and myself has over 10 plus years of real estate investment experience as owner and operators. Donnie has 12 plus years of accounting. He left corporate America and started his own businesses, and he has 3 successful businesses in the Houston. I myself is a licensed professional chemical engineer and have been working for the last 15 years in the oil and gas industry. Our family have lived in Houston since 1995. And as you can see here, we have 2 awesome daughters. We love to go hiking and travel. So that's a little bit about us, the DROX Investment Group. And feel free later on, I know Don is in the back, and he will provide our website. And if you want to talk to us more in one-to-one, we will happily to talk to you about it as well. Okay. So now I'm going to go into, now you've been hearing me about, talking about general partners or limited partner. What does that really mean? So before I dive into the definition, just imagine you're sitting on the bus, there's a driver and there are passengers. So the general partners sometimes interchangeably used as the word sponsors. Imagine them as a driver, right? So the driver will play a very active role when you're driving a bus. They will doing the daily operations. They will, the general partners will basically act on the behalf of the company. And most importantly, the general partners or the sponsor itself has all the liabilities in terms of when something's going south. So for example, when we going out and purchasing a apartment unit, the general partners will have to sign on the loan. It's kind of like when you're buying a single family home, right? You will have to sign your name on that loan. So the general partners will sign on the loan, and the lenders were looking at the credit score, the credit history, the net worth of the general partners or the sponsors in order for the lenders to actually providing a good interest rate. So therefore, as a limited partner, you kind of like the passenger, you're relying on the bus drivers to take you from point A to point B. For the limited partners, or sometimes you may hear it's like passive investors. So just imagine yourself sitting in the back of the bus, enjoying, reading your books, playing on the phone, doing whatever you love. So that's what the limited partners in the multifamily syndication world look like. In exchange, so basically you invest in the projects. So in exchange for part of the percentage of ownership based on the amount that you put in. So that is also a very plus there, is because you are still going from point A to point B, right? And you also have a percentage of ownership, but you're not really doing the daily work. And what's another thing that many limited partners are really, the advantage of that is the limited partner has limited liability of the company liability index. What does that mean? If something going south, right, and you're the limited partners and you invest only $100,000, if somebody come after that company, they do not go to your own personal net worth. Unlike general partners, they will go after us. However, for the limited partner, you are protected in the box and only incur up to the amount of the principal or the capital that you invested in. And many of passive investors really enjoying that. And you don't have to even put in your, you're not signing any loan documents. You're not putting in your net worth. The lender is not looking at your credit score. So that is one of the great leverage in the multifamily syndication structure that we put in a DROX Investment Group, where we can help investor like busy professional like all of you who want to invest into real estate, but you're busy doing your own professional professional works. So therefore you can be a limited partners as well. So just imagine, that's why I want to put in a very plain term, just drivers and the passengers. On this one, I'm going to share with you more on, this is an example of the Grayson and Baybrook. This is the executive summary. So typically in every offering, we will have a webinar where we describe more of all the offering, the executive summary, the business plan, what are the return, and what's it in for you as a passive investors. So I'm giving you this example because we closed this, the Grayson and Baybrook. This is actually located in Houston. We closed it in 1st of June, actually, so 15 days ago in the DROX Investment Group. And so for here, as you can see, typically in the executive summary, we will provide you what does the offerings, what is it, right? Because we want to make sure that you know exactly what does your money, where does it go and what is it doing. So for example, the Grayson here, the purchase price is $68 million, right? And we have this was built in 1999. It has 97% occupancy. So you see the word capital budget. What does that really mean? So $1.8 million capital budget, when we present it to our investor, what that means is we allocated $1.8 million in order to enhance the property. For example, like upgrading the units, interiors, right? Or even exterior, like putting the EV station into car charger in order for us to increasing the amenity or increasing rent. So capital budget, that's what it means. Secondly, the next one you will see here is like the number of units, meaning how many units, how many doors does that apartment actually have? So in this apartment, the Grayson, it is 322 units. The estimated equity here is $21 million. What that means is, before many of you may be very familiar with your primary home, right? So when you're buying a primary home, you're putting typically 20% down payment, and the rest is 80%. You going to the bank and loan that out. So apartment is very similar. It's just a bigger scale. So we putting around 20. This is like around 25% down payment. So that's like the equity that we need to put in, that $21 million. And the rest, we go to the loan, the lenders, and loan it out. So here it's typically like around $50 million, right? That we need to go to the lenders. And the 21 million is the equity. But I want to emphasize this. So when you say if you put in, let's just say, simplicity, $200,000, you invest in this, what percentage of ownership do you actually have? So the ownership percentage is calculated based on the equity of that $20 million. So if you invest, let's just say for simplicity, $210,000, that means your percentage of ownership for this particular apartment is actually 1%, right? So it's not part of the purchase price, it's the equity. And that is the beauty of it. So now while you're working as a busy professional, you still have that part of that ownership into this apartment based on your capital. And you can see, 1% of this amount is a huge amount when you're doing the profit sharing, okay? Typically, our projected hold period, what does that really mean? Is 5 years, meaning once you invest within around 5 years or even longer, we will sell and basically return your money. We say typically 5 years, we can, because why is that? Is, as you know, real estate, there's an up and down, right? But looking at the last 15 to 20 years historically, when it goes down, it will go back up, like 2008, 2009, the housing crash, as you know. It went down 2 or 3 years, right? But it went back up. So typically our hold period, we say is 5 years, but this doesn't mean 5 years we sell. We may sell it earlier or we can sell it later. And distribution quarterly. You say, what does that really mean? So for us, when we're looking at the projects, it needs to stabilize. The apartment itself, like a business, it's already stabilized. Like you say, 97% occupied, right? So the first day when we acquiring it, we already have the cash. And from that cash on, we'll say, we don't want to hold on to it. We want to return the money back to you if any profits that we have. So distribution, we say we already projected to be a quality distribution. So every 3 months after we acquiring them. So the very first distribution, we expect to be 6 to 9 months. That's a typical projects that we have. And then after that, we will have a cash return for you. And this is why it's very attractive for many passive investors because, for example, if you're just buying a land, right? If you buy land, you're not going to have a quality distribution because there's no income coming in. And you only have to wait until you sell that land to get your money back or the appreciation. But unlike that, the multifamily, since our strategy is stabilized apartment and 97 plus or 90% plus occupied, we already have the cash on the first day. So therefore, we also providing you that cash on cash distribution. The next one I want to share with you is the return. And this is the why, because when we do something, when we invest in something, we was like, why do we need to invest in that? And this is the financial term. And Donnie later on, he's with accounting background. So I'm going to let him provide more details on what all these financial terms mean and what is the return when you invest your money in the multifamily offering, okay? And the next one is the where. Typically, we always present is where is this property located at? And for the DROX Investment Group, we are very strategically looking at a location because, like you say, real estate is all about location. So we're looking at, where the location is at, need to be at least 90% plus occupied. And, like the Grayson one, this one we have here, for the last 10 years, it's been on average 94% occupancy. The rent growth here is like 17% rent growth, right? It's in a very great school district. And not only that, we're looking at the jobs, the jobs, the economy within 5 miles and 10 miles, because that is where your tenant will go to work and then stay here, right? We don't need to look further away. And we want to ensure you those type of investment highlight. And that's very important because like I mentioned before, real estate is about location. So when you're looking at the offering, you want to know where is this property is located at. And last is the how, right? Once you invest, you will have this partnership structure of, okay, there's a profit sharing between the general partners and the limited partners. Remember, the bus driver has to do all the daily operation. Someone has to pay for that, the bus driver, right? The general partners. And as a passenger, you also, since you're going from point A to point B, you want to reach your financial freedom, you also have to have, the return for your capitals. So how do we distribute that? And then later on, also, Donnie will go into more in detail of the acquisition fee, the asset management fee. These are the fee that for us in DROX Investment Group, we provide as transparency, because we want to let you know if you invest with us, this is all, there's no hidden fee. Everything is clearly and provided very upfront. Okay. Okay. Next up, I want to talk to you about the property type. As you can see, you probably, I didn't go over the Grayson. The Grayson itself, you can see, is a Class A property. And you might hear from many others offering that we have. You may hear like Class A, Class B, Class C, Class D. What does that really mean? So let me just put it in a plain term, because not too technical. Many of us, when we travel, we go to the hotel. And when we look at the hotel, we look at different stars, right? We go from a 1-star to 5 stars hotel. So if you look and, someone tell you, oh, this is a 4-star hotel, 5-star hotel, you say, oh, that's a great hotel already, right? So Class A property is very similar to that as well. Class A just considered to be a 4 or 5-star hotel. That means the amenity, the rents are much higher, and it's actually located in a great school area. Class B, where you can say is more on like a 3 to 3.5 hotel, where you can looking at, yes, you need to spend more money on maintenance and capital expenditure to upgrade, but you also have a value add, right? Because once you upgrade that, you can actually increase in rent. Same thing in Class C, and then Class D is more on the fixer upper itself. So hopefully, if you have, this is, so when we providing the offering, we say, okay, this is the Class B. And then, this is always a great area as well, because sometime when you say, okay, it was built, in 1980, but there was a major renovation in maybe in 2010, would that be a B or is it A? So sometimes that's why you can see there's a Class B plus or B minus or A minus, things like that. But just roughly, because when you see, when they say, oh, this is a Class A, a Class B property, you may have a rough understanding of that in that type of terminology. Okay, so next up, we are going to get into the heart of it, of most of our offering is the financial terms itself. So I'm going to turn over to my dear Donnie, and he will talk to you about the financing terms. Over to you, Donnie.
All right. Thank you, guys. My name is Donnie Trin from DROX Investment Group. Thank you for joining us today. All right. So let's move to the next slide here.
There may be some technical difficulty here.
Okay, hold on. Sorry about that.
Okay, we need to find this. A patient with us here. Okay.
All right, thank you for your patience, guys. All right, so most of the investment offering that you guys see out there, there will be most likely they're all projected, right? No one can read into the future, so most likely you will see projected type of investment display. Okay, but what I want to show you guys here is when you guys look at this slide here, typically it's not all the same, right? Different type of structure, but in this case here, we have two type of limited partner, Class A and Class B, right? But the first terminology I want you guys to look at is the total return, right? What is total return, right? Total return is basically your total return on your investment. This could include capital gains from the sales, dividends, distributions that has been realized over the period of time, right? Equity multiple here, in this case here, is a 2.19x. What does equity multiple means? Usually it's fairly simple. It's very similar to total return, but it is expressed in terms of a multiplier. Okay, in this case, it's a 2.19x. So, so if you were to invest a $200,000 investment in this case, the projected total return is 337,000, or total return wise is projected as a percentage. Usually you see 119%. Okay, so those are the two terms that I want to start off with when you're looking at as an LP in terms of the investment here. Okay, it's pretty much a total return at the end of the day. What is that projected return looks like? Okay, if there's some aggressive return, I want you guys to really dig into the details when there are very aggressive that are similar type of property. Okay, so next up is cash on cash returns. So what does that mean? Is cash on cash return is simply an annualized cash return on an annualized basis. Okay, again, these are projected. For an example, in this Class A here, year one, you are getting about $7.6 thousand in return in year one. In year two, about 11.9. Again, there are projected returns. Okay, so it may vary year by year as the sponsoring team utilize the cash for purpose of CapEx or stabilizing the property. Okay, so that is cash on cash return. It's also something to look at. Okay, do be mindful on the cash on cash return. As a higher class type of property, they tend to give you a lower cash return, but towards the end, of the sale, usually it's an appreciation type of play. But do be careful on cash on cash return. If it's high enough, sometimes it's too aggressive. Just be careful. It's a riskier asset. Okay. Next, on the next slide, I want to show you. Also, there is another financial instrument on here that's not shown here, is IRR, which is internal rate of return. It's not shown here, but it's also another financial instrument to look at. I just want to note that, if it's a high IRR, it's definitely look into detail on the reason why is an aggressive projected type of returns. Do look into that, and also look into the sponsoring team and their past performance and what does that look like. Okay, so next up, I want to show you this this slide here. This is usually a financial analyzer type of slide here, but what I want to show you here is the projected pro forma. Okay, so what is pro forma? It's pretty much a projected market comparable rent, right? That is projected, that the property projected to grow to, right, based on surrounding market condition, right? So that's pretty important in terms of what is being projected, where can we get to it, and how, right? So our pro forma rents are based on research from our property management team and then also ourselves. Okay, when we say ourselves, is pretty much us boots on the ground. Where are we looking at the surrounding area? All right. We also use industry data to back us up in terms of reports like CoStar, Yardi, apartment data, RealPage. Those are industry data that help us project a return where we're planning to get the property at. Okay. But do know when we present a pro forma rent, you know that it's been researched and backed up by industry standards. Okay. So next, I also want to point out, as you can see on this slide here, there are a lot of information here on what to look for. The loan to cost, for an example, close to 76%, and some of these closing costs and the whole thing. These are some of the projected type of returns and details that we have projected. Okay, so definitely look into this, some of the returns into details, and definitely if you guys have additional questions, it's time consuming digging into the details. So if you guys have questions, we'd love to spend that time with you. Okay, so what I want to show you guys next is the financing. Okay, so what I want to show you guys on this slide here is the interest rate. Right, we all want to look at the interest rate as interest rate grows, but there's two types of loan. Usually it's fixed or is a bridge loan, whereas it's a limited 3 to 5 year type of loan, or usually bridge loans are interest only. So in this case, we have a interest only type of loan. So what does that usually mean when you look at this type of offering? Okay, it means that it is interest being paid to the lender on a monthly basis. Okay, and there is no principal payment. There is no principal payment. Okay, the other things I want you guys to look at is also the loan type. This is a 5-year non-recourse. Okay. But do be careful on what non-recourse mean. But then there's always some sort of recourse related to loans, okay, due to some of those bad boy carve outs. Okay, so they always want to be protected. Okay. Another thing I want to note that you guys want to look at when you look at this type of financing structure is there a prepayment penalty? In this case, there is none if we hold the property for over 18 months. Okay, so definitely look into this. I know there's a lot of deals out there that want to get out before they might have to pay the penalty for that. So definitely look into that and make sure you understand your team. Okay. Oh, I did miss something on the previous slide that you need to look at also is the rate cap. Okay, so again, there's in this offering, our rate is a variable rate. So what that means is that it's floating. Okay, so in this case, most lender requires us, or most of this type of structure is to purchase a rate cap. Okay, so what does that mean? What is the purchase of rate cap? That usually means is that based on this rate 2.71, right, 3.71, the highest it will get is the 3.71 plus that 2.75%. Okay, that is the max in terms of rate that we are going to pay before the insurance of the rate cap kicks in. Okay.
Let me also intervene a little bit. Not intervene. Let me jump in a little bit too. On this interest only period is because remember when I mentioned on cash, right? You may say, how can with this type of structure, how can you guys making so much can return on the cash? It's because when we don't pay the principal, kind of like your primary home, right? Or your single family home, you always have to, when you monthly payment, you paying for the single family investment, interest only and principal. But here, since we only paying for the interest only, we actually save those principal when we dispose. That means you actually getting your cash on cash, that distribution, higher cash on that. And that's the plus in the multi-family structure that we have, because you are leveraging on the general partners, net worth and the credits right? Because the lenders are very smart. They're not going to, they may need to make sure that all these general partners, network can even, over that loans period. And another one I know we talk about is the amortization period. You can see. So the interest only that we have is, the loan that we have is interest only, and is amortized for 30 years. So therefore, each payment that we have is low. So therefore, we can bring back your cash on cash itself. Yeah, that's all I have.
All right, thank you. Okay, so going on to the next slide here. All right, this is, I love this area of cost segregations. It's pretty much the depreciation that I love, okay? It's just that, I'm a business owner, being able to save on tax, it's a beautiful thing, right? So why is cost segregations important, okay? So cost segregations is pretty much a method of reclassifying, right, components of your commercial property. What this allowed is that it allows asset to depreciate from a 3, 5, or 15 years instead of the traditional 27.5-year type of period. Okay, so it pretty much being able to depreciate the bulk of your commercial assets in year one. Okay, so basically in what this study does and the engineering firm does for us is that they go in and reallocate a lot of sections in terms of the building, right? So you can't depreciate land, right? So the rest of the building, the land improvement or personal property, those are the items that they're going in and cost segregate, so to speak, and then they estimate, okay? So based on the current year of 2022, which is the last year of what we call bonus depreciation, okay? So for this example here, the projected from based on the initial estimate that the company came in to look at is that if you were to invest in $100,000 in this investment, $85,000 to $100,000 is your depreciation that you can take, okay? So depreciation is just a paper loss on your tax form, on your K1 that you're able to see and identify and use against other passive income, okay? But if you're a real estate professional, you're able to max it out as much as you can against other W-2 income, but we can also talk about more on the real estate professional status, okay?
Can I jump in?
Yeah.
Yeah, I just want to jump in. This is where many professional, when you have, like when Donnie mentioned about passive investment, right? Let's just say you have other rental property, single family rental property, and you have those income. And then if you invest in this multifamily at the end of the year, let's just assume you invest $100,000. You can actually take that whole 100,000, assuming that 100% is depreciated. You can take that whole $100,000 and offset that with your others operating passive income, like your other rental. And that's $1 per dollar. And that's extremely powerful, how we distinguish between real estate and stocks, because stocks is not going to give you this type of depreciation. Because right, you always hear about, hey, how come rich people cannot, they don't pay that much tax. It's because they're having this tax advantage that we have, especially in this real estate here. So I know future-wise, hopefully in the next several more series, we are going to have I'm already working on a CPA, so she can actually providing you a more in-depth detail of this depreciation and how's that going to help you offset your tax $1 per dollar when you're investing in the multifamily syndication structure like that, what DROX Investment Group is offering. Okay, good.
Okay. All right, thank you, Gwen.
Thank you, Dan. No.
All right, so lastly, what I want to talk to you about is the profit sharing structures. So definitely I want you guys to look at is, industry standards between when it says class A and class B, this is not property class, okay? This is investment class, okay? Most structure supply a very simplistic type of return. Either it's one class, it's just 80%, 80-20 as the industry standard. In this case, for those who invest more for our Grayson Class A, it's an 85-15% split between the limited partners and the general partners. Okay, so just be aware of that. Definitely look into that. If there's structures that's different or higher, definitely look into it. Just be careful based on what are they doing and how are they returning your investment at the end of the holding period. Okay. Another item I want you guys to look at is the asset management fee. Okay, so what is asset management fee? So this is the fee that the sponsoring team is taking in for managing the property and the property management company. Okay, we are leveraging our experience, our decision making, our knowledge and our experience in executing what is best for the property here. How do we go about increasing? At the end of the day, it's all about net operating income. Okay, so how do we go about increasing the net operating income and increasing the value of the property? Okay, and making sure that we return to you guys in a proper manners. Okay, so this is where the 1.5% comes into play in this example. In the Grayson here. So definitely look into this. Definitely look into reason why certain these structures are different. Okay. Also, I want to note is the acquisition fee. Okay, definitely look into this. Here, the acquisition fee is 1%. Okay, this is the fee that the sponsoring team are taking in. It's a one-time fee. Okay, versus the monthly fee of the asset management fee. This is just a one-time fee where we spend a lot of our time structuring the deal, underwriting the deal, gathering their team, leveraging our net worth, our liquidity, and being able to win deals in a particular type of setting. When I say setting, it's more of like what is that locations that we want to purchase in, and whether it's a safe area or not. So there's a lot of things that's in the past that in the background where we utilize our expertise in. Okay, so the acquisition fee is the 1%. So definitely look into that and understand why that comes into play. Okay. Also, there's also a disposition fee and refinance fee. Okay, so in this case, the Grayson deal, we are not taking a disposition fee or refinancing fee. So some of these fees, disposition fee, are related to the sale of the business, preparing the property. Okay, there's deals that do take for whatever reason that it makes sense to them. Okay. And then also there's the refinancing fee. I want you guys to pay attention to. It's pretty important that this refinance fee does come into play. For us, we're not taking any fee and from our investors or from us, and we just want to make sure that we are clear in this area. Okay. All right. I am going to turn it over to Huynh.
Okay.
Whether she wants to add any notes.
Okay, I know we are in the already 45 minutes into our timing. So that's what we're asking for, 45 minutes. And the next one is, let me see. I think this is at the end, because if we need to go more, then we can have part 2. But I know we don't want to spend much of your time. So I'm going to go through the chat group and any question you people might have. So I see that once own a fractional share of the entity that's owned. Okay, let me see. Charles asked this. Okay, so he asking about the sponsor cut, and as you can see here on the fee. So the sponsors, the mainly is the profit sharing, right? As you can see here, the Class A winner, and this is what Donnie mentioned from Class A. This is investment Class A. So if you invest $200,000 or more, we consider as a Class A, and that's the profit sharing split between the LP is 85% and the GP is 15%. Because whoever the investor that put in $200,000 has a higher risk. So we want to, when you hire higher risk, there's a higher returns. For Class B, 80-20% split. For all of our offering, we rather be very transparent, be upfront with those type of split that we have. Okay, Charles also asked, is bridge loan? Yes. And why are we, and I want to mention this, of course, we don't just always go to the bridge loan, or it depends on what's the best return for our investors when we go out for lenders. Kind of like when you're buying a single home family, right? What's the best the return for you? So when we go out and seek for lenders, and especially with the experience that we have many times, we have many lenders that came to us and providing us the best rate, but we're not only looking at the best rate, but we also want to look at the best terms. So for the Grayson, when we closed on June 1st, but all this lending was like several months ago. At that point of time, our interest rate, as you can see, 3.71 is actually extremely, I would say, awesome, right? It's really great from that standpoint. And so we selected that particular lenders, and with the interest only 30-year amortization, because that will give our investor the best return, and that's how we select it itself. Okay, and interest reserve, yes, we do have the interest reserve, as you can see the previous slides right there. We do put that in, and that's where, and great question there, because why is that? We are very conservative in our underwriting. For this Grayson, I believe we put in $500,000 on the interest reserve itself because of a lot of uncertainty. So we like, we are not going to we want to make sure that we have that reserve, so in case of any rainy days. And the amortization itself, oh, okay, Charles asked, did we buy the rate cap as you see? Yes, we did buy the insurance rate cap, and that's what Donnie's mentioned. What that means, why are we purchasing that rate cap? It's because we want to protect the investors' money. So if the interest rate go above whatever that rate cap is, we are protected and we are capped. And that's what it means on the interest rate cap, and we have purchased that. And that's basically kind of like the insurance, right? And when you're buying a home, you're always buying insurance just in case of something do happen. So in here, we buy interest rate cap insurance in order to lock in the rate in case of some things, the Fed goes up above what we expected.
Hey, I have a question on that, Wen.
Oh, I think I heard some question, but let me go down the list as, okay, this is depreciation. Okay, depreciation, I can probably talk for another 45 more minutes or longer. But however, Donnie and I are not a CPA, and we are actually going to have a guest speaker CPA. So just be patient with us. We're gonna have a CPA come and providing a whole webinar to talk about the depreciation, because that is the key and the most distinguished between why you should invest in real estate multifamily and not in stocks. And this is how you get to your financial freedom much faster. And I want to, specifically putting the allocation, like, 45 and whole hour to that, rather than just briefly go through it. Okay. Thank you, Andy, for that. You say one owns a fraction of the property. Let me see. Oh, okay. So currently right now, we have invested in 6 deals. So the Grayson overall is our 6th deal in so far itself. And I know many people have already asked, so when Donnie, when is your next deal? And this is what I honestly always tell people, right? Is we don't just go and get deals. It's kind of like, it needs to be perfect like earth, right? It needs to be like the great investment for our investors. It needs to be in the right location. But the key thing is it needs to have the return for our investor, because I always put myself in the investor's shoes and I say, should I invest in this deal or should I invest elsewhere? What is better? right? And I want to make sure that we are confidently that when we are, taking the money and that putting that ownership, that we can, I mean, nothing is guaranteed, but at least we understand the risk and we can providing you that return, because in this type of investment, it's always the long term. And we want to make sure that, once you receive your distribution, you've seen how we work, you will very pleased with us. And also you referring to your friends and family, so we all can grow together. So we don't really have a definite saying when is our next deal, but please rest assured, Donnie and I are working very hard to find the next deal.
Okay.
So
We have our last question for the night.
oh, okay. I know we're going that. Okay, so Richard asked about the interest rate cap. Is that a one-time expense? Yes, it is. It is the rate cap, again, the interest rate insurance. We purchased that before we closed, and that's already built into our capital raise. Like as I mentioned before, that $20 million raise that we have, equity, right, itself, the equity raise, kind of like when you're purchasing a single home. I always refer back to that because I know many of you are familiar with that. When you're buying a single family home, you put in your 20% down payment, but and this is a business, so you always have to allocate an extra for your capital expenditure, for improvement and other expenses. So the cap rate is part of the expense. So, and all the other fees that Donnie mentioned earlier is part of expense. It's not about, you as a passive investor pay to us. In a way, yes, you say it is, but it's part of the company expense itself. And the interest rate cap, we purchased it one time. It is a one-time expense. It's not a monthly expense. And so Richard asked, so what if the interest rate exceeds the rate? And great question. That's why we cap it. So if the interest rate, let's just say, knock on wood, if the Fed saying, hey, I want to raise the interest rate to 10%, we are capped. We are capped to what those numbers that we have. And that's kind of like our insurance, because why are we willing to pay the insurance? Is because to protect the investors' money, right?
So when it does exceed, that interest rate cap, what happened is that the insured that company will start paying us back for that interest amount. Okay.
Okay, great. I guess we're almost up to the hours, and thank you everyone so much for your time. And feel free to have a one-on-one conversation with Donnie and myself. And then secondly, if you have any other additional topics that you would like us to talk, discuss a little bit more, please feel free to email us, because we, again, the objective of this webinar is we want you to be confident when you invest, right? And I believe, knowledge is power. So until next time, you guys enjoy the rest of your day, and good night, everyone. Thank you so much.
Thank you, guys.
Mhm.